Red Cloud Financial Services is your preeminent source for mining industry opportunities. The team provides a unique, tailored marketing program dedicated to reaching the right people from its mining-focused global network, giving clients access to industry-leading events and conferences, retail and institutional marketing, plus an in-house growth-driven digital agency. Red Cloud Financial Services has access to some of the mining industry's most notable companies and CEOs.
Hello and welcome to this live core conversation brought to you by Red Cloud Financial Services. I'm your host, Mark Bunting, the host of RCTV. We have a great show lined up for you today. We're going to get to lots of stock ideas in the precious metals sector and other sectors, so don't worry about that. We'll get to those towards the end of the show. We're also taking your questions either at the end of the show, or maybe I'll sprinkle a few through the rest of the show. Just put them in the comments section on the right-hand side of your screen. We see a number of people in there already, including a gentleman whom I believe I went to school with maybe 50 years ago. If it's the same person, maybe we'll find out. Let's bring in our guest today, Rick Rule, the president and CEO of Rule Investment Media. Great to see you, Rick. Thanks for doing this.
Mark, it's a pleasure to be back on with you. Thank you.
Absolutely. We last talked at VRIC in Vancouver in January, and going back, call it 10 years, if not more. I used to interview Rick regularly on BNN on Market Call, and it was also always a treat for me. So let's get going here. I want to start with big picture. Bear with me. I got some facts and figures just to make a point, and then we'll see what you have to say about it. But going back to the late 60s, M2, or the money supply of the United States, the broadest measure, has gone up by about 40 times. Over that same time period, gold is up 66 times, and the S&P 500 is up 58 times. Another stat, going back to 1999, gold has an annual compound growth rate of 10.4%. And Rick, you said that over the similar period, the U.S. dollar purchasing power usually declines annually by about 7%. And one more stat here, debt in the United States sits around 35 trillion and growing, and that's not including entitlement programs. So wrap all of that up. Is it just inevitable that gold is going to continue to march higher?
I think inevitable is too strong a word, but I think that the intelligent investor pays attention to probabilities, given that certainties aren't on offer. And I think the probabilities are that gold will, at the very least, maintain its purchasing power, something that I don't think either the U.S. or the Canadian dollar will do. So I think that people need to understand that. I also think, Mark, that people need to understand, in addition to reversion to mean, overshooting mean. And that's important for gold investors and speculators to understand. The market share of precious metals and precious metals related securities stands at all-time lows. In the United States, less than 0.5% of total savings and investment assets are denominated in precious metals and precious metals related securities. The 4-decade mean is 2%. If we saw reversion to mean, which I think we're going to see, the idea that you would quadruple demand for this asset class would obviously have a very dramatic impact on prices, and in fact cause the prices to increase more rapidly than we have seen in the immediate past. Will that happen? For sure? I don't know. Is there a probability? I think so.
Now, Rick, we've seen a record central bank gold buying in 22 and in the first half of this year as well. And combine that with the fact that the foreign countries just are not buying as much U.S. debt as they used to. Back in the day, it would often be oversubscribed when the U.S. would issue debt. And now sometimes it's the foreign countries and entities are buying maybe 30 to 40% of that. Do you think those two factors combined is the main reason, a fear of a lack of purchasing power in the U.S. dollar?
I think there's two reasons. One, I think you put your finger on. If you believe the US stated rate of inflation, the CPI, then you believe the deterioration of purchasing power of the US dollar is proceeding at 2.6. The problem with the CPI is that I don't think it's an accurate measure of the deterioration of the purchasing power of the US dollar. Your US dollar savers in your audience need to ask themselves what's happened to the price of gas at the pump? What's happened to the price of food? What's happened to the price of health insurance? And in particular, what has happened to their tax bill? Taxes aren't included in the CPI. I would suggest to you that the real deterioration of the purchasing power of the US dollar is closer to 7.5. If you subscribe to that point of view, then arithmetically the problem becomes obvious. The US 10-year Treasury pays 4.2 in a currency where the purchasing power is declining by 7.5. In effect, the US government is promising to reduce your purchasing power by over 3% a year compounded for 10 years. Not a very good deal. Mark, put on top of that, the US government has been actively weaponizing the US dollar and US treasuries, regardless of how you feel about Russian behavior in Ukraine and other places. The US government attempted to extraterritorially impose their will by stealing $300 billion worth of Russian assets denominated in US treasuries. If you were another administration in another part of the world, that sent you a very, very clear warning sign. The weaponization of the SWIFT banking system by the US government in terms of their sanctions opposition is another reason why regimes around the world are instructing their central banks to find a different medium of exchange, a different store of value relative to the US dollar and US 10-year treasuries. So, first of all, arithmetically, the Treasury is a lousy deal. And second of all, the US is no longer a fair arbiter of international trade. They've weaponized the dollar. And those two things have caused foreign central banks to need to begin to de emphasize the dollar in favor of gold.
All right, you make some good points there. Now, still with gold, um, it can be argued that this bull market started around 2016 and is really getting going now as we've seen these continual all-time highs. We know that the last big gold bull market lasted about a decade from 2001 to 2011. So can we argue, or let me just ask you the question, do you think that we're getting maybe towards the end of this bull run, or could it last a few more years and this is where the real money is made?
Yeah, I don't think in this case past its prologue particularly. I think that the strength in gold really has to do with the deterioration of the purchasing power of the US dollar. And my own belief is that that deterioration of purchasing power continues and perhaps accelerates. Again, let's look to math. The on-balance sheet liabilities of the US government exceed $35 trillion. In fact, they're closer to 36 than 35. But more importantly, the net present value, not nominal value, the net present value of off-balance sheet liabilities in the US exceeds $100 trillion. Now, the on-balance sheet liabilities are growing because of the structural deficit by about $2 trillion a year. And it's estimated, although I've never seen firm numbers, that the increase in the net present value of entitlements is increasing by between $2 and $4 billion a year, which is to say that the aggregate deficit in the United States, on balance sheet and off balance sheet, is growing annually by more than total government revenues. If you believe that the US Congress is going to stop excess spending, if you believe, like your prime minister would have you believe, that your budget's going to balance itself, if you believe that the real interest rate, net of the rate of inflation, will go positive, then you don't need to own gold. I don't believe that any of those things are true. I believe that the policy response to our budget means that the way that we in the United States as a society will deal with it is by maintaining the nominal level of government spending and benefits while inflating away the net present value of the obligation. There are historical precedents for this. It is suggested by the US government, perhaps an authoritative source, that the purchasing power of the US dollar in the decade 1970 to 1980 fell by 75%. In other words, we dealt with the legacy of debt and benefits by inflating away the net present value of those benefits. And I believe in this circumstance, past is prologue. Historically, the best way to deal with a circumstance where the spending power of your savings is being eaten away by inflation has been to own gold.
Let's keep that theme going. That segues nicely to my next question. It's kind of easy to make comparisons to the 1970s, but it also can be instructive as well. And you did just there. So, what's the same and what's different?
What's better, I guess, is that the U.S. society and U.S. markets are much broader. The United States, for all its faults, first of all, has the best fiat currency in the world. All of the negatives that I described point out to something that Doug Casey says, which is to say the US dollar is the worst currency in the world, with the sole exceptions of all of the others. We have a tremendous franchise in the United States, which we're doing our best to destroy, but it's got some life left to it. The second positive is technology. The US culture is still a place where 5 or 6 kids can commandeer a garage in Sunnyvale, California, and out pops Google or out pops Apple. And we are able to generate more economic activity with less capital input than we used to. That's all good. The bad news, and it is bad news, I think, are that the markets have lost control of the interest rate. There used to be something called the bond vigilantes. When inflation got out of control, they wouldn't show up for treasury auctions. There was no tolerance for quantitative easing. That's changed. A different problem is that if you dial us back to earlier periods, aggregate debt to GDP on balance sheet was sort of 35% of GDP. Now aggregate debt to GDP is 110% of GDP. We used to be able, in periods of time where there was economic stress, push on the rope through quantitative easing or through borrowing. It would appear to me, are approaching a Minsky moment, a moment where if we either resort to trying to expand the Fed balance sheet or quantitative easing, that we run the risk of a real challenge with regards to market confidence. I don't think we're there yet, but the fact that we began this period with on-balance sheet liabilities to GDP at 35%, and now we're at 110%, it tells me that at some point in time, we run out of string to push.
To your point about debt to GDP, the Congressional Budget Office in the United States, which is nonpartisan, supposedly, is projecting 171% debt to GDP by 2054. And that is assuming no recessions, no wars, no pandemics. And just, I'm not asking you to forecast here, but if debt to GDP and the debt pile just keeps going up, how could that manifest in terms of something breaking in the system? You mentioned confidence or a lack of it.
Well, I think that's one thing. I mean, I think that the possibility exists that the question will be called by a crisis in confidence, a 2008 style event. I'm not saying it's going to happen, but it is a contingency that I'm certainly trying to insure against privately. The other circumstance is less dramatic, but unfortunately, I think more certain. Again, if you dial yourself back to the decade of the 1970s, you see what happens to your own purchasing power, to your own savings, if the official policy is to devalue the dollar. If, as an example, you're a Social Security recipient and you're counting on $2,500 a month in Social Security, you'll get $2,500 a month. They won't default on the nominal value of your payment. What will happen is that 10 years from now, $2,500 will buy you $400 worth of goods and services. And I think that less dramatic circumstance is what most of your listeners need to pay attention to. That is, certainly think about what would happen if there was an overnight reduction in confidence, circa 2008. But think much more about the gradual deterioration of your living standard as a consequence of the devaluation of the purchasing power of your savings.
Shifting gears here somewhat, Rick, but sticking with gold, we know that Costco every now and then sells gold bars, and they sell out in no time. Do you think that Costco, by doing that, has brought a new type of investor and maybe younger investor to the gold market?
That's happening all by itself, Mark. As you know, for a decade, I have graded investor portfolios. People send their portfolios to me and I rank them. And I have noticed in the last 5 years that my audience has gone from looking very much like myself, old, fat, bald, white, to being majority under 50, majority non-Caucasian, and 35% female. So I don't think that Costco is as much changing the market as they are reflecting a changed market. In other words, I think that Costco saw latent demand among their customer base for gold. And they saw a market too where the existing merchants in the space, be they online or physical bullion dealers, were maintaining spreads, 7 or 7.5% commissions on the buy side and the sell side, where Costco could come in and disrupt the market. By Costco's own suggestion, they see the gold buyer as a big ticket, high end buyer. So offering gold almost as a loss leader, a somewhat more expensive loss leader than their roast chicken or their hot dogs, I think is part of the retail strategy of Costco to bring in the big ticket buyers to the Costco stores and accelerate the sales of other goods and services that Costco has on offer. The amazing success of their bullion, really truly across the length and breadth of the United States, has, I think, been instructive as to the latent demand for gold as a product.
Right. You make some good points there. And Costco, as we know, does skew a little higher end in terms of its customer base than, say, a Walmart or others. Let's get to silver. You said you've been seeing something lately you've never seen before in your career, and that is central bank silver buying. And I saw you interviewed, and you gave a few ideas as to why it may be happening. Have you drilled down more? Have you put your finger on why this is happening?
Wish I could answer that, Mark. It's a total mystery to me. Historically, central banks have liked the liquidity and the store of value aspect around gold. And historically, central banks, when they've talked about silver at all, have talked about it as a more speculative asset. It could be that central banks are beginning to study prior bull markets, and they understand that as the precious metals narrative extends itself to Moz and Paws, retail investors, that leadership in the market goes from gold to silver. In other words, it could be that central banks are becoming more speculative. People who are better students of precious metals markets than I have said that they believe that central banks are trying to establish domestic silver markets and encourage domestic savers to save some of the economic surplus that they generate in silver. In other words, making these purchases to legitimize silver ownership among their citizenry. The truth is, Mark, I've thought long and hard about this, and I've come to pardon me, I've come to no conclusion at all because I haven't seen it before.
Now, as you know, silver historically will lag gold when it's running well, and then it eventually catches up and often outperforms. And I know that you've said you think 2025 could be a very good year for silver stocks. So where do you stand right now with that view?
2024 has been a very good year for silver stocks. The truth is that the junior silver stocks in particular were roundly hated. The failure of the sort of Reddit silver squeeze left a whole generation of young speculators despising silver. So the silver juniors, November, December, January, were stupidly out of favor. And I commented on that at length on BNN. That basket of assets is uniformly up 200, 250% in 9 months. So I suggest that the valuation difficulties that we saw in the junior silver space certainly have been weeded out of it. If the $35 price tag holds, what I think you are likely to see, and we just saw it with Hochschild's, is that finally the increased silver price is outpacing the escalation of the input costs, and you should start seeing some better quarterly numbers, operating numbers among the silver producers. If that happens, I think the silver producers, the bigger silver producers, are going to catch a bid. I'm not suggesting, by the way, that we're in the point in time with the precious metals narrative where the generalist money comes in the precious metal space, which has traditionally been the condition precedent for the silver market to outrun the gold market. I don't know if we're there yet. It has been interesting to see the signs of strength, the signs of life in the silver market, but I'm not prepared to concede that we are yet in the position where silver assumes leadership from gold. My suspicion is that the market continues along a traditional path for a while, and gold continues stronger than silver.
Well, we know that you've lived through the two big silver spikes going back to 1979, 80, and then 2011 as well. You can argue 79, 80 was an aberration with the Hunt brothers, but just wondering about these types of silver bull markets. When they do happen, they're infrequent, but when they do happen, you said they are very rewarding, truly amazing. But you have to have the stomach to handle the volatility. So, what kind of a mindset does it take for an investor who may not be that comfortable with a lot of risk?
Uh, uh, an investor who isn't comfortable with risk and volatility needs to just exit the space. There's just too much brain strain associated with the amount of money that you can make. The silver market is for an investor who can tolerate 10% volatility the same way he or she tolerates inhaling and exhaling. Speculators are interesting in that upside volatility is something that's an affirmation of their suspicion. Downside volatility is something that shakes their core beliefs. People who are emotional to that extent need to find something else to do for a living. They need to stay out of the silver space. And impatient people need to stay out of the silver space. You can look at any number of factors that you want to, including technical analysis, and be tricked by false breakouts. You have to understand that in order to be right, it may take you 2 years or it might take you 3 years. And then you don't worry too much about indicators because when silver assumes leadership from gold, the move in silver and the silver stocks is so dramatic that you don't need to look for subtle signs. It announces itself. You don't need Rick Rule to tell you that something's changed because the market will tell you that, and it'll tell you that loud and clear. But it could be 2 years from now. It could be 3 years from now. It could be 6 months from now. I'm not smart enough, and frankly, nobody else in the world is smart enough to tell you with any degree of certainty when that might occur.
All right, great stuff. I want to head to the personal side of Rick Rule just briefly here because you said something in an interview that I had never heard before. You may have said it publicly before, but I had never heard it. And that was that in the 1970s, as a younger man, you were doing very well career wise. You were a wealthy young man. But then the market turned, and around 82, 83, you said that ultimately you wound up with a sub zero bank account. And the main culprit you determined was hubris, that you were just too arrogant, too cocky. So what did you learn about that period of your life, and how do you apply those lessons even to this day?
Mark, if you are in the natural resource-based businesses, including precious metals, what you learn is that they're capital intensive and cyclical businesses. Uh, Commodity prices, peak to trough, can easily fall by 50%. Uh, Earnings in commodity-centric businesses can fall sub-zero, which is a different way of saying markets work. If you assume then that markets work and that you are in cyclical, capital-intensive businesses with very long lead and lag times, what you have to adopt is the understanding that you are either a contrarian or you're going to be a victim. In the decade of the 1970s, I didn't know that. I was interested in natural resources. And as the price of natural resource commodities went up, and as the performance of my investments went up, I came to believe the prognostications of the big thinkers, the Club of Rome, the Royal Bank of Canada, uh, people whose inputs became more important, more broadly assumed as being correct, with price affirmation. But the very fact that markets work meant that the boom that we were engaged in the 1970s was going to become a bust. As a young man, uh, not having experienced market cycles before, I thought that a lot of my investment performance had to do with my own brilliance. That wasn't the case. The oil price went from $3 to 30. The gold price went from $35 to $850. The copper price went from 25 cents to a buck and a half. I had the wind in my sails. And the very fact that those markets did so well meant that the commodities that they produced began to experience substitution, and the supply of those materials over the course of a decade began to increase. Increasing supply, reduced demand means falling prices. When prices fell in 1982, I found out just how smart I was, which is to say, not very. That actually benefited me. It was unpleasant, but going from being a very wealthy, hyper confident young man to a young man with a net worth that was sub-zero, who came to understand more about how smart he was or how smart he wasn't. And also coming to the realization that I had to be a contrarian or I was going to become a victim, meant that I was equipped to operate in the business that I had chosen to operate in. And the 40 years since that experience has been very, very good to me. Not without some mistakes, but I've understood the basics. And by the way, understood them viscerally, the unpleasantness, the pain of going from being a hugely successful young man to having a sub-zero net worth. Mark is with me till today. It's a very, very, very useful part of my backstory.
Well, that's fascinating, Rick. Fascinating story, and we love the Rick Rule that you've become at 71 years old.
Kind of you.
Let's get back to rating your portfolios over the last 10 years or so at Rule Investment Media. The one thing that you see investors do time and again much of is seek alpha, and they're speculating way too much. Can you elaborate on that?
Yeah, investors do two things that are bad. First of all, they mischaracterize themselves. I know that if I ask most of the people whose portfolios I grade to describe themselves as investors, they'll say that they're conservative investors. In fact, they're mostly wild speculators. It's okay to be a wild speculator, but if you're a wild speculator, you need to precondition your speculation with doing a lot of work and having big tolerance for risk, and also allowing time to give you the benefit of compounding. Many of those speculators invest in narratives, invest in themes that are 5-year or 10-year themes, but the tactics that they employ are 2-month or 3-month tactics, which means they set up to fail. The second thing, Mark, is that most people own too many stocks. I frequently come in contact with investors whose portfolios look like mutual funds, laundry lists of 40, 50, 60 stocks. I have long suggested to speculators that the number of different companies that they can own in their portfolio should correspond to the number of hours per month that they spend studying their portfolios. And by spend, I don't mean watching BNN, although that's a useful pastime. It means reading annual reports, reading quarterly reports, reading proxy statements, reading insider filings, reading resource statements, reading analyst reports. If you are willing to spend 10 hours per month, I would suggest that your portfolio should have 10 speculations. But thousands of the portfolios that I have graded over 10 years have been circumstances where people were prepared to work 3 or 4 hours a month, but they own 40, 50, or 60 stocks. The speculative methodology, pardon me, the speculative methodology that they were employing was, quote, got a hunch, bet a bunch. And that never works.
That brings me to what you describe as your three key advantages in investing. And I'm paraphrasing here, but you're contrarian, which you mentioned. You're very patient. You do the work, which you just talked about, doing those deep dives into companies, and that you have a big picture strategy and a long term perspective as opposed to a short term. Can you sort of briefly run through those?
I think that's right. When I look at in speculation, the real winners I've had, the 10 baggers, the 20 baggers, the 100 baggers, uh, there's a few similarities. The first is that it takes time. My average holding for a 10 bagger has been 5.5 years. Many speculators have trauma holding stock over a long weekend. The eighth wonder of the world, the first wonder of investing, is compounding, and it takes time to compound. Many investors don't have the patience. The second is a stomach for volatility and a stomach for cyclicality. Most of the 10 baggers that I've enjoyed in my life have exposed me to a 50% share price decline during part of the period in which I owned the stock. Many investors that have less knowledge about the stocks that they own, that don't have the same perception of value, are unwilling or unable to hold the stock through a 50% share price decline, and are certainly unwilling to add to their position on weakness, which I am. The third is I'm very willing to do the work. I read all the time. And if I come up with a question about a company that I don't know the answer to, I pick up the phone and call the company, or I pick up the phone and I call somebody who I think knows more than me. The fact is that I do the work. I'm not suggesting I'm always successful. Nothing could be further from the truth. And if I could add a fourth variable, Mark, that I think is important, in coming in contact, a lot of contact over the years, but in particular for 10 years with Eric Sprott, I've learned that a speculator, pardon me, needs to tolerate loss. If you look at Eric's success over 40 years, Eric has had more circumstances in his portfolio where he lost money than where he made money. But the wonderful arithmetic of speculation is that if you have a Kirkland Lake or something like that, if you have a 30 bagger or a 40 bagger in size, the money that you make on your successful speculations more than compensates you for the more frequent 25 or 30% losses, and leaves room left over for a very acceptable rate of return. My assumption now as a speculator is that my decision is a mistake. And if some piece of news comes that seriously debases my thesis, I sell the stock without any sense that I'm going to get back to break even or something like that. Which is to say, press wins, cut losses, assume losses, assume as a speculator that you're going to make more mistakes than you have successful decisions, but have the courage and have the knowledge to let your successful decisions run so that they amortize your failures and leave enough margin left over to compensate you for the risk and the work.
Feed your winners and starve your losers is another way of putting it, as you know. So that makes a lot of sense. We're talking to Rick Rule of Rule Investment Media. We are going to get to some stock ideas in just a few minutes. I'm going to fold in a question here from MA with one of my questions. And I think in the course of the answer from Rick, it will likely be answered. How do you know if a junior company has good deposits, assets? And my question, Rick, along with that, relates to the fact that you've said that about 75% of juniors are valueless, quote unquote, and really only about 5% of the junior explorers are the ones where the money is made. So can you combine those two questions? And
Yeah, I think the 75% number is generous. I think more like 85% are valueless. And I think that almost all the money is made, in fact, over the cycle on 5%. And with juniors, Mark, I really truly start with people. What you find out is that bad guys can wreck good rocks, Good guys end up with good rocks. So dealing with people who have been serially successful, not with the lame, the halt, and the blind, is the place you start. Good people find good deposits. Now, uh, having said that, the investor or the speculator needs to equip himself or herself with the knowledge necessary to separate deposits among good, bad, and ugly. For myself, that has to do with size to begin with. I want an exploration target, and I want that target, by the way, to be defined both by surface and by the third dimension, a drill hole at least. I want a reasonable target. I want a target where I can infer uh, a minimum of 2.5 billion US dollars worth of in situ recoverable reserves and resources. I want to believe that my deposit has the possibility, ultimately, to be in the lowest cost quartile for its commodity worldwide and the best return on capital employed, but at any rate, 25% or better. And then I discount those targets by the amount of data I have and the certainty of the document. The first document, of course, would be a resource statement, third party resource statement. The second document, still very inaccurate, but the first targeting document would be the preliminary economic assessment. The third document would be the pre-feasibility study. The fourth document would be the bankable feasibility study. Um, in other words, you have to do the work. That's not what most people do. They say, I think silver's going to run. And they hear a tout about, silver orangutan or silver aardvark or some TSX penny dreadful whose only claim to silver is that it's part of the name on the share certificate. People need to understand that if a commodity runs and your company doesn't have any of that commodity, it doesn't make much difference.
Rick, we have a question here from AN. Before I get to it, I want to preface it by saying it's about Newmont. They actually hold shares in Newmont. The company came out with earnings. The stock is now down 15% today on pretty well, let's call it quadruple the regular volume, the average volume. It's up to 24 million today. This, of course, is one of the bigger producers in the world, if not the biggest, and was having a great run. I only skimmed the surface of the earnings. I don't know exactly what happened. I think they missed their numbers, although earnings were up about 6 times from last year. So the question is, and prefacing this by hopefully you have an answer to this, but comments please on Newmont's dismal report today. This is from AN.
I think dismal describes it. The company has been a serial underperformer in terms of making its own guidance and making the guidance from brokerage firms who have been informed by Newmont. It isn't a problem with this quarter particularly. It's a problem that's persisted over several quarters. One is instructive to the industry, which is to say, at the same time that the gold price has gone up, the cost of inputs has gone up. So the margin increase that we hope to see quarter by quarter by quarter has been muted by the fact that labor costs have gone up, social costs have gone way up, energy costs have gone up. But in Newmont's case, they had guided the market with regards to expectations as to what to expect on a quarterly basis. And they haven't managed to achieve that, in direct contrast to companies like Agnico Eagle. What I think Newmont investors need to look at is the ongoing process, which they have stated will continue, where after the Newcrest merger, they sell off all of their tier 2 deposits, all of their smaller deposits, using the proceeds from those sales to strengthen their balance sheet, while at the same time allowing them to focus their management attention and their capital budget on tier 1 assets. If they are successful in doing this, if you see the pace of dispositions into, by the way, a very strong property market increase, I think that you will see that the Newmont numbers increase as they focus more management time and attention and more sustaining capital investments on optimizing higher quality, larger assets. To the extent that the disposition process falters, I think you'll see continued disappointment. So I think the jury's really out on Newmont, and it'll have an awful lot to do with the implementation success that they enjoy in disposing of selling their tier two assets.
All right, very thorough answer. Thank you for that. Here's one from Pony Hunter. You've mentioned, Rick, you would have made plenty more money had you only backed the same successful management teams. We know that there are some older people who've been around a long time getting out of the business, and then some new young blood coming in, so that may not have a prior track record. So what do you look for in that case?
I will speculate on young new people. If a whole bunch of old timers like myself have already vetted them and are already investors with them, if there's a young team that's brought to my attention by Pierre Lassonde, as an example, and I notice that Jonathan Goodman is also a backer, and then my sort of team from what I laughingly call the Colorado School of Mines Mafia also likes this young person, I will certainly take a shot. I'll take a shot for a younger person who has a godfather, that is to say, a management team backed by a Ross Beatty or a Bob Quartermain. But I will no longer take a green shot. I will no longer take a shot like I did years ago with Brian Dalton when he was a pimply-faced 23-year-old undergrad that didn't have the backing of a high-quality team. It's important to note that some of the high-quality teams have begat high-quality teams. I began investing with the Lundin family in 1974, long time ago, with Adolf Lundin. Investing with Adolf Lundin, I came to know two young men, Ian Lundin and Lucas Lundin, who became superstars of their own right. And now I'm investing with the third generation of Lundins, Lucas and Adam's sons, trained by people who I knew and trusted and loved, and also the drivers of an organization of skilled individuals who were assembled by their predecessors. So it's interesting, in the same fashion that I invested with Ned Goodman for 40 years, and I'm completely comfortable today investing behind his son, Jonathan Goodman. It's not necessary that one trusts one's future to completely unproven youngsters.
And by the Goodman family, you're talking about Dundee Corp, of course, right? Did you hear me, Rick?
Yes. No, that's exactly
sorry.
right. Exactly right.
Yep. We'll get back to some questions. We'll try to get to some more in just a while. I want to get to some ideas here. I know G Mining you like, and you'd also like to see G Mining, speaking of Lundin, hook up with Lundin Gold. Is that a probability, do you think?
Probably a pipe dream. I know that an amalgamation of high quality assets generates a larger market cap and hence a lower cost of capital. The only knock that one could possibly have against Lundin Mining is that they're a single asset company. If they went to 2 or 3 assets, they would be rightly perceived as having lower operational risk because you spread the risk over more deposits. The Lundin family were founding shareholders of G Mining. And in fact, the G Mining team, the Gignac family, were the ones who built the Lundin gold deposit, Fruta del Norte. The amalgamation of Lundin and G Mining is a pipe dream for me. I didn't hear it from the Gignacs. I didn't hear it from the Lundins. It's just a fantasy that I hope to put out in the market loud enough and long enough that it's caused to occur. I think that would be a circumstance where you have a one-by-one merger that generates 3 as opposed to 2. You answer the growth question because of the G Mining pipeline having acquired the Oklo asset from Reunion. You have the stability question because the Lundins always end up owning 20 or 30% of their problems. And then you also have the multi-asset premium in the market, which you don't see single asset companies enjoy. I'm not trying to give the market any leadership on this. I'm trying to be very noisy about my preferences around two different companies where I'm a decent sized shareholder.
I know you like West Red Lake gold mines. We interviewed the head of IR, Gwen Preston, at the Red Cloud conference just the other day. We know Frank Justra is a key component of that as a big time investor in there. What is it about West Red Lake you like?
That's highly speculative. I like the price that they paid for the asset. I like the long-term strategy of using the production infrastructure to consolidate satellite deposits within trucking distance of the Madsen facility. And I'm a long-term fan of Frank Justra. This is decidedly more speculative than G Mining or Lundin. People need to understand that. And it's something that will take much longer, I think, to bear fruit. I think that somebody who owns West Red Lake needs to have a view to own it for long enough that they can return the asset to production, that they can do the delineation and definition drilling that the prior owner of the deposit didn't do, that they can affect a strategy of regional consolidation. To truly profit from West Red Lake, I think investors need to have a 3 to 5 year time horizon. I've watched Frank for 40 years. He has a 10-year time horizon, which is exactly what I think you need to have. I think to own West Red Lake too, as a speculator, you need to have a tolerance for failure. It might not work. And so you need to use money that you could afford to lose 30 to 50% of in hopes of enjoying a 5-bagger or a 10-bagger in the company of very good people around an asset base that was acquired very opportunistically.
Rick, what's your favorite silver name right now?
I'm not sure I have one. My suspicion is that if we do see a breakout in silver, that one of the prime beneficiaries will be Pan American Silver. It is disappointed for 6 straight quarters, so it's in the penalty box. But I think you have a circumstance where their gold assets, in particular, will begin to perform on a quarterly basis. In other words, I think you're going to get some earnings surprises to the upside. There's also superb optionality in Pan American Silver in the sense that they have an asset in Guatemala which isn't producing, which is a 500 million ounce high grade deposit. They have a second non-producing asset in Argentina, which is also I said 500 billion, I meant 500 million, a 500 million ounce deposit. So there's optionality upside should they be able to return either of those two projects to production. And of course, there is a cult of shareholders around Pan American Silver, both silver holders and Ross Beatty aficionados, that was built up over 30 years. The fact that there is a wonderful audience looking to react to good news means that to the extent that we do get a silver breakout, Pan American Silver should be a good beneficiary. It's also, I think, relatively cheap based on its assets. It's relatively cheap because, frankly, in an operational sense, they've underperformed expectations for several quarters. I think that they are working out the operating kinks, particularly in the assets that they acquired from Tahoe, and that will be reflected in operations in the next 2 or 3 quarters.
Rick, you're doing yeoman's work here. A few more questions for you, and we'll get you out of here. Question from Paul Formanco, and Peter Mazzeros is also interested in what do you think of Majestic Silver taking over Gatos Silver? Is that a good move?
It was a very full price. I think potentially it is a good move. The near-term cash flow, well, 2 things. We've shown that amalgamations work in the market. Bigger companies have more trading volumes and they have a lower cost of capital. So that obvious market synergy comes into play. With regards to Gatos, the cash generation at Gatos will, of course, if it's deployed intelligently, really benefit the combined companies. What you have to deal with there has been the reserves shortfall, which is to say the fairly short mine life at Gatos. And it'll be interesting to see if recycling the cash generated by Gatos will allow them to increase reserves and resources elsewhere fast enough to deal with the reserves shortfall that punished Gatos so severely pre-merger.
Turning to uranium, a question from AN. Do you have an opinion on UEC, which has a market cap of about $3 billion now? Is it fully valued? And second part of that question would be, do you have a favorite uranium name?
I suggest that UEC is fully valued, and I suggest it's going higher. They have a very, very good, very, very focused management team. I don't think the consolidation is done in UEC. UEC has near-term growth both in Texas and Wyoming, albeit with some local challenges. They have a very strong balance sheet, and they have been very disciplined building the company. In addition, they have an off-balance sheet asset that I think the market needs to understand. Amir Adnani has spent probably $100 million over 20 years in financial public relations in his various companies. And he's built a uranium cult at UEC. A 90 to 100,000 investor strong community that is like the Pan American community, predisposed to want to react to good news. And so I think that you'll see special performance in the stock around the uranium narrative if the uranium narrative continues. I would suggest for most of your listeners that my favorite uranium stock would be Cameco. The risk in Cameco, I think, is that the company has elected to buy 50% of Westinghouse, which is to say they've gone from being a mining company to being a full service uranium company. If they pull this off, if they go from not merely producing uranium, but actually selling watts, selling electricity, constructing plants for other people, trading uranium, doing enrichment, this will be a long ball home run. The question is, can they manage that many businesses? They have been extremely disciplined in the last few years, shutting down production when they thought that the cost of producing those pounds in the long term was going to be in excess of the selling price of those pounds. And they have resisted, even with higher spot prices, putting production back into production until they had contracted for that production in the long term so that they could assure their shareholders of a reasonable return on capital employed. That production discipline, I think, is wonderful. I think another thing about Cameco, particularly for uranium junior speculators, is that Cameco has material that they don't include in ore calculations right now that any other junior in the world would kill for. To the extent that we see persistently higher uranium prices and uranium prices that are accounted for in term contracts, in other words, where Cameco has the ability to know the price and volume of production in future years, that you will see that uranium turn to account in Cameco, which people haven't paid any attention to whatsoever. For most people, the beta in the uranium market, that is to say, the extent to which the uranium producers outperform the broad market, will be sufficient. You don't need to chase alpha. You don't need to come down to the lower quality players. And you should concentrate on the biggest and the best names like Cameco. For those of you who are willing to do the work, absolutely, positively, look at the 10 or 12 uranium juniors that have economic deposits now and will benefit from their ability to sell production from those deposits into the term rather than the spot market.
All right, great stuff, Rick. One more question here, and then we're going to give you a free 60-second commercial to let us know what's going on at Rural Investment Media. Last question here. I'm going to sort of cut it down a little bit, but Bruno Urbisti, what are the three commodities you're most bullish on the next 3 to 5 years or so?
I think that depends on for who. I focus on commodities that are hated, which means I have real patience. And so what I say for me might be different than what I say for other people. Almost everybody in the world is underinvested in precious metals and in precious metal securities. We talked about the fact that they are stupidly underowned relative to the macro picture. investors who don't own gold and investors who are willing to do the work that don't own gold stocks are, from my point of view, illiterate. They haven't studied history or economics. So I would suggest for most people, precious metals is where they need to be. I've been aggressively in precious metals for the last 5 years. I don't need to add much, but I've done that. I think investors too, who understand the importance of the term market in the uranium business, can afford to own the uranium juniors, but most investors won't do the work. The commodities that attract me on the basis of hate are very different. I was a lithium bear for a very long time. Now that lithium is decidedly out of favor, I suspect a year and a half from now, I'll be an aggressive lithium bull. We were never short of elemental lithium, Mark. We were short of production capacity. We were short of the ability to turn raw lithium into lithium chemicals. And the industry's had 7 years to deal with that bottleneck, which they have done. Billions of dollars went into lithium exploration at much higher prices. And those exploration efforts were successful. There are probably 150 nascent lithium deposits on various stock exchanges in the world. 7 or 8 or maybe 10 will go into production over the next 5 to 10 years. But just as the investors bought lithium stocks with no work done on quality, they're selling them with no work done on quality. And I think that the lithium stocks will become as oversold as the uranium stocks were. So I'm trying to determine for myself what are the 5 or 6 or 10 best lithium deposits in the juniors, with the view to buying very, very big positions in those over the next 2 years. If the hatred for lithium that I suspect will come to exist does come to exist. Certainly the acquisition by Rio 10 days ago of a lithium junior postponed my plans. I need to say too, I'm also attracted to sulfide nickel deposits, which are in the toilet, really as a consequence of the incredible production increases that we've seen in lateritic nickel. But the story, nickel as a battery metal, has disappointed an awful lot of people. And I'm beginning to see the hate in the sulfide nickel deposits that I like to see as a conditioned precedent for my own buying. Finally, the high quality rare earth deposits outside China have disappointed investors mightily, and people have come to hate rare earths too. So I'm looking for very high quality, large rare earth deposits that are hated by investors, where the output of the material won't be in the Chinese processing train, but will rather be in the Western processing train, which I think will add a scarcity value.
Last question for you, Rick. What's the latest at Rule Investment Media?
Well, past is prologue. As you know, Mark, we put on an annual conference in Boca Raton, Florida, that I think is the best natural resource conference on the planet. Anybody who comes who doesn't think they got their money's worth, tell me, I'll give you your money back. Every quarter, we do a deep dive, a boot camp, where we spend 8 hours on one topic. We've done uranium, we've done silver, we've done royalty and streaming. We just did one on tier 1 deposits. Every 90 days, we do one of those, 99 US dollars, not for tourists, only for people who want to work hard for 8 hours and review the tape several times in the course of a year. Again, full money back guarantee. Perhaps a better deal for your listeners, though, is any of your listeners who go to Rule Investment Media, who care what I have to say about natural resource investments, can personalize it. Go to ruleinvestmentmedia.com, list your natural resource stocks, and I personally will rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues if I think my comments might have value. Please, 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 no crypto, no tech stocks, no pot stocks, no psilocybin stocks. Leave an old resource guy to what he does best. Rule Investment Media, list your natural resource stocks, no charge, no obligation. I personally will rank them 1 to 10, 1 being best, 10 being worst.
Rick, you've given us an immeasurable, incredible amount of information and knowledge and experience from your experience. So that's been an amazing hour. Thanks so much for your time today. Our viewers definitely thank you, and I thank you.
Well, Mark, I'm a longtime fan of yours, so I appreciate the opportunity to talk to your audience through you as a medium.
Yep, that was fantastic. We hope to do it again. We'll let you take a breath, get some water, and we'll see you next time. Thanks again.
Thank you, sir.
Okay, Rick Rule. I always say it. How great was that? Thanks for your questions today. I'm glad we got to a few of those, and that is definitely worth watching again to listen to his answers. Just so much information, and he's a guy who's been around for so long. He's seen it all, done it all, and still deeply, deeply involved in the natural resources sector, doing the work. So we hope you enjoyed that. We'll see you next time on another live core conversation here at Red Cloud.